Welcome to another value investing webinar. Today we are going to talk about what goes inside the mind of a value investor, the kind of markets we have been through. Value investing can be rewarding, but it can be very painful. How do you navigate? How do you manage your mind? How do you manage your thinking? The kind of self-doubt, the experience of catching a falling knife. You have your belief, you have done your diligence, you have your thought process, and then you see everything crumbling. And all your diligence is not showing result. How do you go about managing yourself? The thought process, the self-doubt, overcoming that. What keeps you going? And how do investors react? Because, this is also, it's also mostly the situation that somebody is managing other people's money. So you might have your belief, self-doubt, whatever, or, confidence, but your investors may not be kind enough. So how do you deal with it? Today, once again, we have Atul Kumar, the portfolio manager of Quantum Long-Term Equity Value Fund. It's a long name. Thank you, Atul, for being here. You have stood for the approach to investing in terms of finding bargain. And now, since the launch of the fund, this one might be the second situation where we see the market crumbling after a sustained growth. So what we are witnessing in the last couple of months. So, how do you deal with it? The feeling of catching a market, a falling knife, or whatever is your existing portfolio, it crumbles. How do you deal with it?
So the way we are seeing this situation is that we were sort of prepared for this. The markets to us looked to be on a zone where a lot of sectors looked overvalued, and we have seen in this cycle there is a correction in a number of stocks, but that is primarily happening around 2-3 sectors where the concerns are higher. Maybe on the NBFC side, a couple of banks have corrected. On the autos side, many of them have.
Public sector banks have been in the correcting mode for years now.
Correct.
We keep getting nasty surprises all the time.
Correct. Yeah. Some of them, public sector banks, maybe the investors' confidence in many of them, their numbers, the quality of governance, etc., has been relatively low for some time. And in our case, obviously, we were looking at. We had our companies ready. We wanted to invest. And then when the markets are falling...
You had the money to invest?
Yes, we did have the money to invest. So our cash levels were much, much higher. Around 20% kind of levels is what we were sitting
at. So a fifth of your portfolio was waiting?
Yes, a fifth of our portfolio was waiting. And then when the correction happens, so... at the first stage, almost everything falls. People are, when some news or events come out, as was in the case towards the end of September, where there was news of a default of one of the prominent kind of finance companies, then almost everything was falling at the first stage. And then obviously as an investor, it is, one has to see that while everything is falling, but within the sector, there are differences, there are nuances, the business model of one company may be different from the other. And that we learn through history. For example, when we are looking at the NBFC space, maybe for the past 3-4 years, many of them were growing very, very fast. They were, while their assets were long-term, they were financing many of them through short-term borrowings.
So this asset liability mismatch would have
correct, yeah.
Hurt them. You anticipated this?
Yes, we were surely seeing that there were excesses building onto that side. But I mean, when it will and what would be the trigger point for that to happen, obviously.
So given vulnerable, it was just waiting to happen.
Yes, I mean there were certainly pockets of excesses where it was on their ALM side. Many of them were getting aggressive on the lending to maybe grow their AUMs. And then again, when we do our own homework, we find that there are companies which have managed through the cycles, which have seen this. They are running much better asset liability management, learning from their previous cycles. These companies which have had a much controlled kind of a growth that makes sure that they will not be having the same problems as the whole sector as such may have. And from there on, one can look at companies, stocks which are looking to be attractive from a valuation perspective, and they still have a business model which is quite strong and resilient.
Before getting on to the key question, that how do you deal with, you had 20% preparedness for investment, but 80% of it would have crumbled. But before coming to that, you have been waiting with a 20% cash position, and then you invested. How does that watch list work? How does something really qualify? Because when the market is falling, market rise steadily and slowly, and they fall very rapidly. We suddenly see a big fall in a brief period. Falls are never gradual. So how do you go about? I just want to understand the process in terms of the deployment plan. That something has happened, and when it's falling, the scare is so much that it could just be the beginning of the fall. It may not be the end of the fall.
Correct. So I mean, the primary work is obviously that for us, we need to have our homework done now.
Just to put it briefly, how do you time it to perfection?
Yes.
Your purchases.
Correct. Yeah. Very difficult to be very, very frank. I mean, you will have surprises on both sides. I mean, as we have seen across cycles, that it may well happen that you may buy something and it falls a lot after that. Okay. And
it happens.
It happens
this time too?
Correct. It did not happen so much maybe this time, because we bought and maybe because the way we understood that something is a great business model, we bought into that, and later on the markets also realized quickly that okay, there may be a problem in the sector, but there are some companies who are managing their business much
to it.
Yes. So from our side, obviously, when there are situations like that, there could be a lot of stocks which could be falling. And then again, we have to take a call that if this is the problem, and this could probably be a new thing to us. For example, let us say when you try to do a sector, maybe you may not have looked at one problem deeply. Mm-hmm. Maybe let us say that you would have thought that okay, it could be related to the asset,
but it couldn't be this bad. Or
correct. Okay. Yeah, or an entirely different problem. You could have thought that okay, these guys are growing fast, so they may have an asset quality problems. But what you saw suddenly was that suddenly the liquidity became tight, and liquidity is become a big problem. Many of them
or disruption.
Yeah. Exactly. Yeah. So obviously, from our side, we.
But that is a one-off thing, that liquidity crunch and, a finance business where money is the oil. If that comes to a standstill, anything will get stuck. And that cannot be anticipated. That is a very generic risk factor.
Yeah.
Which will happen every few years. In a decade, you'll have it once in a while.
Yes.
But the fundamental thing that how do you, implement to perfection, how do you time it to perfection is what I was trying to understand.
So the timing is not as you said at the starting, that many a times it can be a falling knife. At points of time, it could be the stocks can rise very, very high. So it could very well, from our side, what is important that we have done our work properly, and there may be a number of stocks which could be available. From there, we have to understand that from those stocks which are the ones which are well positioned, and they may not go kind of a belly up if this kind of a situation of the problems, even if they are persisting to a certain extent. And then I mean
they will survive.
Correct,
they will navigate through this
exactly
period. Okay.
Then we have to take a call that there has to be a confidence in a particular business model. So as long as that confidence is there, when a particular stock is meeting all the right checklists in an environment where there looks like a crisis kind of a situation, because as it is that many of these things can also be very temporary, and the good guys, they can withstand that. Not just that, but what we have seen in many of the cycles, that in these kind of scenarios, the new players or the aggressive players, they get out of the business. They are wiped out, and probably a lot of business comes to the ones who have done their business in a wise manner.
The strategy that you follow, trying to look for a bargain and invest in that comes with, the understanding that you will have a period in a roaring market. You will have a period of sustained underperformance, and then you are faced with a decline, and you have taken that into stride, that okay, you will be focused on quality, you will be focused on bargain, you will maintain cash if you are not looking for getting opportunities, and then you will see a decline, and then you would see a decline where you have also fallen as much. There isn't a reward of being thoughtful or being conservative with your so how do you deal with it? How do you reconcile with this thing that your investments also get punished in the same manner, or do they?
Correct. So if we have to look at it, the first part of it, when the markets are rising and there is less to deploy and underperformance which happens as a result, that to us is a period which is while we have to live with it, but that is surely a period or a time when we are concerned that we always wish that we are fully deployed.
The period of underperformance in a rising market, or period of the free fall in a falling market?
Yes, I would say that the first one is a much more a bigger problem. The second is where, let us say, if somebody is fully invested and even if the stocks are falling, the person cannot do much. You can just sit at your losses. If there are redemptions coming, you have to fund those redemptions. Fortunately, in our case, that is the time when, contrary to the industry, we are happy because we would like to be invested.
No, but there are stocks which are... Do investors also put more money?
What we have seen is that our performance certainly gets better when these kind of falls happen.
You stand out. You do better.
Yes. So which would have been the case very recently as well. That we would have done relatively better, clawed back a lot of our underperformance, if not all of it. And
I want to ask a very different question. I want to understand this actually. How are you configured as a group, as a team of portfolio managers or analysts to derive this, courage of conviction to go against the herd? Because you're normally buying things, which are not in favor, or, which is not popular, which is ignored. And then in the short run, one doesn't get a comfort that this is not the racy part of the market. The numbers are not stacking up. So how are you configured? What kind of thought process, what do you discuss in the morning while having a coffee with your colleague that, to derive this?
Correct, yeah.
Because it's being contrarian in an otherwise very racy market, or investing in a crumbling market.
Correct. So, what I could say that as an institutional as well as an individual, what we have seen that many times the markets more period of time are irrational rather than being rational. In the markets, there are many type of investors, and increasingly people are looking at shorter return horizons. People are looking how their portfolio is going to do in a week's time, in a month's time, and accordingly many people are positioning, and I mean the reason why they are behaving so is because there is a pressure. Let us say a marketing team is telling them that okay, the scheme is not getting sold. You have to
getting money because
we are not getting this thing. So in our case, I would say that the things are very, very different. The portfolio runs the way it has to. The marketing side runs the way it has to. Nobody,
independent.
Yeah, nobody can interfere. So that gives a lot of.
So you're never under pressure to perform.
Yes, there is never a pressure to underperform in the short run. I mean, obviously, over a longer period of time, we would like to do well. But then, I mean, if you look across cycles, I mean, you look at today, for example, the biggest. I will not take the names for it, but if you look at today, the biggest FMCG company, probably it would be trading at maybe PE valuations of upwards of 40. Look at that company, what happened between 1998 to 2008. The market cap of that company between the last 10 years leading up to 2008 was flat because of people were seeing in that period a lot of growth happening on the industrial companies, the capital goods, because it was the capex cycle which was driving the economy, and people were seeing that okay, you are getting only a 5% or 10% earning growth in those kind of companies, so why would you buy that? Now just cycle changes in 1 year. Come 2009, the global economy is in a pressure, the capex cycle is turning down. Now people will look at defensives. So I would say that a long-term investor can play a lot and take advantage of the irrationality which is there in the market. So a lot of our calls which have been there, that have been because a particular sector which trades at or should normally trade at a valuation of X is right now trading at X minus 20% or X minus 30%, because in the short run, the people are worried that it may not be delivering results, and in their portfolios, it will do nothing. And when it does nothing, then there is a lot of under ownership. So
running these funds and running this strategy, what is any other challenge that you face, and how do you deal with it behaviorally? Because it's all trying to manage in your own mind, reconciling with it, making a justification, building conviction, or changing your mind sometimes. So how do you, what are the challenges that you face?
Okay, so I would say that one of the things which can happen because you are managing money over you have a long-term thesis. It is very important to revalidate that thesis.
Keep reminding yourself
every time, because you may think that okay, I bought this for XY reasons. Now it may not do well, let us say in the short run, which we are totally prepared for. But is the company headed or its financials are not
so validity of the thesis is still intact, revisiting that all the time.
Correct.
How often you do it? Any position that you have?
Yeah, so everything, all the stocks which are there as a part of portfolio or there as a part of research database, we look at the numbers once every 6 months to make sure that we are not going wrong on those companies. And it's important to sell.
So did you come across a situation that 80% of your portfolio which was already invested, you came across a situation that, okay, now we have to give up on these?
Not because of fall of the markets. We have never sold out of them, and fortunately our investor base is also quite good in the sense that people who have invested with us, the way our marketing teams have sold the funds, that they are long-term investors, so they will not withdraw out of the markets at the drop of a hat. And so the reasons why we would sell is primarily, until unless obviously the biggest reason is that once our stocks reach the targets which we have set. But that apart, there have been in the past cases where we have made mistakes, and what we found that those companies could be worth, or the way we thought that these companies are going to...
So big fall don't turn out to be triggered for you to take a call or anything at all?
No.
They do not precipitate some problem in the company where something becomes visible. Because, in good times, a lot of things are not visible. Tightened situation, and then you suddenly come across a lot of things crumbling.
Correct. So yeah, in our case, obviously,
you didn't get surprises.
Yeah, we do not. Actually, we would act contrarian to that. If we are seeing that the stock we believe in and that has fallen, maybe in these, if there is a big fall, we would add more, because by that you are averaging your cost, as long as there is a belief that the business model is good. Which mostly it works out. I mean, in 90% of the cases we get it right. I mean, few cases where the stocks may not have.
Let's quickly now move to some questions which we have got for you, which Sandeep is asking: what is the difference between value and growth at reasonable price? Growth at reasonable price, the two strategies, if you have to contrast these two.
Correct. So, I mean, obviously many people are looking at different metrics, but I would say that whether it is growth at reasonable prices or even value, even in the value there has to be a catalyst for the stock. So to my mind they are relatively similar. I mean, obviously there can be this thing, but ultimately when you are buying a particular stock, you are buying it that in the sense that if today something is worth 100, it becomes 120 or 130, and then you sell out. So I would say that, I mean, even for a value stock, there has to be a catalyst, which is the case in the case of, let us say, when we are saying growth at reasonable prices. Otherwise, it will forever remain a value stock.
Sumit has this question that how important is book value from value investing perspective?
Yes, so book value obviously makes a lot of sense, but then again there will be sectors, there will be industries where I mean book value has it will not have. So
in
anything
a technology
which is
company or FMCG company where something else is the asset,
correct,
book value may not be relevant.
Yeah, correct. Yes, they may have a, let us say, a different. You may have a, let us say, a brand, a copyright, or something which may not be
intellectual property.
Correct, exactly. Yeah.
Company,
so that's right. So in some other industries,
in
it may be
plays, book value will be relevant.
Yes, in the asset plays, mostly the book
Companies
values,
which are very capital intensive, asset heavy.
Correct.
So okay. Iqbal has this question, which is a very direct question to you. In your quantum long-term value fund, I observe that you are holding a significant portion of your value in debt. Debt meaning cash or fixed income or whatever. Why have you not deployed that amount? Are you expecting the market to correct more?
Correct. So, I mean, obviously, this is.
So you were referring to 20%. How much of it is? How much of it is now?
Yes. So, I mean, it would have.
It would 20%?
Have breached 10%. So it would be lesser than 10%.
Less than 10%.
Correct.
Okay.
Yeah, which will be. I mean, which will come out in our.
Has there been a situation that you are fully invested?
There have been times where we have been fully invested. For example, in the post-Lehman period, our cash levels would have been just about 1 to 2% levels, because
almost
there we were
tending to be zero.
Yeah.
Okay. So 10% is still the headroom.
Correct. Yeah. I mean, there can be, if the markets give us an opportunity.
8 to 10% is normal preparedness. This is a normal preparedness which you would like to have all the time.
I mean, we would like to be fully invested, given an opportunity to us.
You think you are in a situation that you can well be fully invested as well?
I mean, very difficult to take a call on that, Dhirendra, because as you know, it's difficult. Yeah, correct. Yeah, predictions.
This is BB Singh, and he's asking, how should one tackle volatility when investing in value stocks as they react faster? Mm-hmm. These are already, out of favor stocks, and sometimes they crumble even more.
Correct.
How do you deal with that?
Yes. So, I mean,
of course, we had the whole discussion around that.
Yeah. Correct. So, I mean, the only one thing I would like to add maybe is what we tell our investors. If you are not in the stock markets, at least for a 2 or 3 year, when you can perspective.
Have a long-term view.
Yeah, correct. Yeah. And you can see your stock falling by maybe 40-50%, you should have that. Okay,
Rohan has a very useful question for you, which is, which sectors have more options of value plays, value buys, where you find the opportunity? Any sector which are, where you find great values today?
Correct. Yeah. So some sectors which would have declined recently, there we
tell
would
me
have,
those.
there we would have. So I mean, at different points of time, different sectors come into play. To give you an example, let us say after the.
Give me more useful thing. He's asking a useful thing. Which
Correct.
sector you think has gone out of favor and become attractive?
Yeah, maybe something like NBFCs which have fallen. There some names would have become quite interesting.
Some of them become very attractive.
Correct, yeah.
Okay. Any other sector which comes to your mind? Steel, which has been out of favor for a long time, or banking?
Yeah, but then again, there could be issues around, let us
Many
say,
companies,
because
okay.
correct, yeah, because let us say when we are talking
I
about.
should just give you a rider that sectors could be out of favor and there could be value there, but exercising your choice is critical. So you have to be very selective, and that requires hard work. So don't try and take a lot of lessons from ideas from this. But yes, you can look at quantum long-term equity value fund portfolio that is disclosed every month. And what aspect, Ankit has this question, that what aspect should one check in a balance sheet while selecting a stock? Any few big numbers, big things which one should start with, and to move further or not move further?
Correct. Yeah. So, I mean,
what to look for in a balance sheet?
Yeah. So obviously, the quality of the balance sheet in terms of leverage, debt to equity, that is an important parameter. How the cash flows, are they blocking some capital? A lot of capital is being blocked on working capital, etc. Those are important things which one has to look at. There can also be other qualitative factors, whether it is in terms of the corporate governance side. Let us say one can look at a number of things to make sure that it is a good kind of a balance sheet.
Ganesh has this question. Normally a retail individual investor does not have access to the kind of information a fund house may have. Give us at least 3-5 parameters which a retail investor can easily use to spot value stocks.
So, I mean, I would like to say in our own case as well, I mean, it's not something, a lot of the information which we are using is very, very public in nature. Okay. There is nothing, I mean, apart from, let us say, correct, yeah, nothing privileged apart from, let us say, meeting the... I think the privilege is that
your full-time job is to look at that.
Correct, yeah, that becomes a competitive advantage. But that apart, maybe we could be...
You have the time.
Correct, yeah, and maybe we could be meeting the managements of the companies at...
get a first-hand view.
To understand
meeting
from
the management, do you really decode something from the body language or just the facts?
Yes, sometimes maybe body language, etc. can also tell you something. But that apart, there is nothing really which is... there is some kind of a privileged information or insider information which is there, at least in our case. I mean, I could say for our funds. I mean,
so after Ganesh, now we have Krishna asking us this question. Should one hold stocks for long period of time or trade in them at frequent intervals? Which way can one make more money? So after all this story, we are being asked short term or long term.
Yeah, I would guess everybody has their own kind of a mental frame, but I think that from investing, what has been seen that being invested in a stock a longer period of time definitely gives you a much better kind of this thing. I mean, now maybe the tax arbitrage has gone to a certain extent, but earlier, I mean, being invested for the long term was even, you did not have to pay any kind of a tax on that transaction.
There was the tax
costs
advantage
too.
Yeah.
Correct. Yeah, costs are much lower. So from a longer term investment horizon, definitely makes a lot more sense. And also you get to ride a lot of volatility, because in the short run you never know which way the markets are going to be there. But when you are looking at a longer point to point time of 5 years, 10 years, people make a lot of money.
I would just conclude it with, the legendary investor Warren Buffett once said that, market is a mechanism of transferring wealth from active to the passive. So, so thank you, Atul, for being here and, sharing how you think in a struggling market or in a crumbling market with your value investing strategies. Thank you for being here once again.
Yeah, it is a privilege for me as well to come once again and share our thoughts.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.